I am Keith McCullough, and welcome to our Investing Summit. This is the 7th year that we've done this. We do it biannually. For those of you that are joining for the first time, welcome, and thank you broadly for this is a record audience for us, and we're quite humbled by that, and that's quite exciting for us as we go throughout this day. Today is going to be the first day where we have 3 conversations, of course, and then we're going to get into day 2 and day 3. But what we do in this is just one second here. What we do in this is have what we try to have is a 40 to 45 minute conversation, with the first 30 to 35 minutes being a back and forth between me and the guest, and then of course your live QA. So again, you just pop questions in the queue, and your questions get voted up or down. So make sure you have some good questions. All right, you should have good questions. For our first guest, leadoff hitter, Mr. Diego Parrilla. Thank you for joining us and for having the bravery to go first, and thanks for dialing the VIX up to 25 just for the Investing Summit.
Thank you for having me. It's a pleasure.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content. Yeah, we have to have the guy who's the volatility guy on a day where we get some real market volatility. Maybe we start with that. I definitely want to get into topics like China, inflation broadly. But a day like today, just to start with that, I don't want this to be just myopically focused on today, but today is the day where people go, wow, that's a lot more energy inflation than maybe I was expecting. It's not certainly not something that we weren't expecting. We're still hocked up on inflation here, but it's a day where they're like, that's not good enough for me broadly for the consumer or for stocks. I think that's kind of the message, at least for now. Rising interest rates and a rising energy tape isn't exactly what's getting everyone excited.
Yeah, I guess it's one of the Achilles heels of the system now. I mean, obviously, the entire debate about inflation, which is, by the way, a no-brainer as sort of one of the degrees of freedom of the monetary and fiscal abuse. This has been dismissed as temporary, etc., by central bankers, sort of kicking the can down the road. Yet we see energy prices creeping in the background. A lot of people obviously focus purely on crude oil, but this is way beyond crude oil. I mean, in fact, the story is much more about natural gas and electricity prices. And it's not just a US story, it's a global story. It's happening in Europe, it's happening in China, it's happening everywhere. And it's a combination of factors that are unlikely to disappear in the immediate future, at least with ease. We're talking about a problem that comes from severe underinvestment over the last decade, plus, due to bad returns, but also looking into the next decade due to all the environmental considerations. So that's obviously impacting the supply side. We have, on the demand side, we have obviously this extraordinary dynamics with COVID, where we're seeing a return with vengeance of the transport, the consumer, and this has been both on the gasoline side as well as industrial, and now potentially opening up on the airline traffic, which is with the U.S. opening up, and this is happening with also climate issues. We had a pretty cold winter last year, and that really basically brought inventories to very tight levels. And the one thing we always say in commodity markets is you can't print oil. Okay, you can print anything you want, currencies and bonds and equities, but you can't really print oil. And that's part of the issue, or natural gas or whatever. So we've seen European natural gas prices go up 10 times since last year, which is just completely crazy. Yeah. In barrel of oil equivalent terms, we're approaching $180, $200 a barrel equivalent. This is three times oil, pretty much unprecedented. The global prices are tightening, and this is happening with inventories that are tight, and as we're heading into the winter. So if you think about, we saw OPEC today, increasing production modestly, 400,000 barrels a day being perhaps the impact less than the expected demand if you get the airlines coming in. you see this huge move in gas prices potentially leading to substitution effects of, analysts say, between 1 to 2 million barrels a day, and also the colder winter, potentially tighten things up. So in a market where things are fairly inelastic, meaning, the ability to respond to increases in prices, be it through production increases or demand destruction, is very limited in energy prices and in a number of commodities. And so the idea of $100 oil is potentially around the corner. If a couple of things go wrong, the products, which is what matters really, things like diesel, are already there. So whilst you see the headline number in crude oil at 80, when you add the margin from distillation and refining, it's already there. And so, if you think about all these dynamics, the possibility of a very big spike in energy, which is really very bad news for obviously inflation and for the world economy, is unfortunately greater than many people pay attention to. And again, this is not something that I think we'll be able to resolve quickly or easily.
Yeah, when you talk about $100 oil and or $10 U.S. gas, obviously European gas is much higher. Guys, show slide 88. I think a lot of people actually, Diego, that don't do commodities but currently look at the natural gas chart, they might say I missed it. I'm talking about the U.S. gas chart, but it's 6. I mean, that's not even remotely close to where natural.
Think about it. One of the funny things in commodities is that we use all these different funny units, right? So MMBTUs, dollar per barrel equivalent, British thermal units, whatever. When you actually, if a very helpful rule of thumb is you convert natural gas prices, you multiply by 5.8, so roughly 6. So the chart you're showing, $6 MMBTU is still 36. So in relative terms, when you look at like for like, apples with apples, natural gas prices in the US are still a fraction of where they are in other parts of the world. And there's a mechanism called LNG, liquefied natural gas, which effectively are like floating pipelines. It gives you the ability to take gas in one part of the world, liquefy it by bringing it to extremely cold temperatures, and then regasify it. And this is not something that is as easy to do because you need to build the infrastructure. And this is a bit like male, female. It's not that easy. I mean, a country like the US was effectively positioned to be an importer of gas, and therefore has the regas, but not the liquefying. And so as the world looks to globalize, you need to do big investments. But in the short term, it's not that easy to actually level in those things. But as of right now, the US has a bit of an edge with lower power prices than other parts of the world. But you should expect some degree of equalization, even if it's very unlikely to arb each other. This is just too big of a gap.
Yeah, I'm shocked that you didn't tell me that these prices were high just due to easy base effects in the pandemic. The fact of the matter is that you gave too big.
A big part of it.
That's what the transitory crowd wanted everyone to believe. The Fed needed to believe. Let's put that on the table. But you mentioned a couple big things. Maybe unpack that. I mean, you got underinvestment on the one side, and we can circle a big circle around ESG there. Potentially, which is a government policy, of course, and then you have on the other side, you really partly explain this due to fiscal spending and money printing. Do you have to unpack both of those things and then pack them back in and just say it's the government or not?
Well, there are plenty of dynamics. I think one of the interesting things that is kind of shocking the market a little bit is we went through this super cycle with shale, for example, and the shale was a game changer because historically, when you thought about crude oil projects, think of Alaska or any others. This is really a very long-term cycle. I mean, we're talking about from the moment you say get go to the minute you see that gasoline in your car. We could talk about 10, even 15 years. And this is the type of super cyclical event that you had in crude oil with extraordinarily long cycles, and that contributed to the volatility. What shale did in some way was sort of dramatically change this because we had the ability to effectively respond to spikes much quicker. and also do it in a way where you didn't create huge damage if you had to close those wells, and also you could do it at a completely different price range. So we've seen how the long-term price of crude oil, effectively these producers needed to borrow money, they wanted to hedge themselves, and they were quite happy to do that in the sort of 40 to 50 price range. And so in that sense, what we've seen recently, and this is partially legislation, environment or others, plus investments and bad investments. I mean, energy got pretty burned several times. You've seen that lack of investment impacting also these parts of the market. So if you look at the back end of the crude oil curve, you're now thinking about 5 years around $55, $60. So still very significantly below the spot. That's something that you could argue both cases, but certainly if we're talking about something more structural in the energy market, it's a great opportunity to lock in great prices. But also on the producer side, it gives arguably less of an incentive, because you might be very touched by the 80 or 90 price in the front, but what really matters to you when you lock this thing. So this is an interesting dynamic. I think it goes very closely with policies and governments, and that's also true for infrastructure and other things that you mentioned, which are they need to plug the hole somehow, and this monetary and fiscal spending without limits is obviously been a big driver alongside ESG and electric vehicles and all sorts of demand transformations, which may or may not materialize. And the risk, I think, given the expectations in the market in some areas, it's going to give a lot of volatility. So we are entering this world where I think volatility is going to remain elevated, and that's because you have push and pull forces that are very extreme in both directions. And so I think it's about which drivers matter most, which ones can you undo. And I think in the case of commodities, inventories are something that are very difficult to come about or to resolve, because it will take a substantial period of excess production above demand before you can rebuild those inventories. And for the time being, the market is in a completely different dynamic of perhaps incentivizing that production and destroying demand, and also looking at substitution effects. So all these forces come into play, and they make it very difficult, but many of them are pointing in one direction, which is higher.
Yeah, a lot of people like to just call this, I mean, there's a macro tourism to it, to be clear, but a lot of people that have been in the transitory inflation camp, i.e. they're not long commodities or inflation. I find that an interesting statement. Of course, if inflation was trending, that would be a core asset allocation. You'd be long the commodities and not think that it was just going to magically go away. But a lot of these people just will say that it's just about the supply chain bottlenecks. It's on the cover of Barron's, for God's sakes, today, or at least this weekend. It's the only page of Barron's that I read. But I mean, it's what it is. And then you have people like you that just explain that there's a longer-term underinvestment. There are massive capex holes in natural resources that, for whatever reason, I mean, I send it to a lot of our institutional accounts or clients, Diego, where they'll have that view that this is transitory and just bottlenecks, and once the bottlenecks come undone, the commodity prices are going to collapse. And I'll say, no. Like, why don't you read, what this person's saying, what that person's saying, this person's saying. And what you find is that a lot of the people that are talking about the supply side and the natural resource capex holes are buy-siders. There are a lot of hedge fund managers, a lot of private equity investors will buy into that view because they're doing the work, whereas the street consensus is a lot more like the Fed's view of transitory inflation.
Yeah, look, bottlenecks are obviously another key factor, and this, I think, it touches on multiple other areas. I mean, one is freight on itself is a commodity, right? And you've seen this explosion in prices, which means if you're transporting, iPhones or expensive stuff, is not so much of an issue. If your cargo goes, the cost of shipping goes from 1,000 to 20,000. But if your product, the entire value is 20,000, then the picture dramatically changes. And this is something that it's interesting. I mean, I've given some thought lately, but how it's actually the cheaper components that are suffering the most, and that in some ways are creating these bottlenecks on bigger stuff, chips included. So I think beyond that, there are other dimensions related to bottlenecks and fiscal and stuff, which ties into trade wars and currency wars. I mean, everything, I think, ultimately everything we're seeing revolves around monetary and fiscal policies without limits. And this, we've talked at length, perhaps, and I think it's worth for people to understand how artificial the entire setup is, with artificial low interest rates, artificial low inflation. But I think one of the dynamics that is also hitting is tariffs. And as we discussed, I think, currency wars is this dynamic where, is the beggar thy neighbor dynamic. I want to basically get out of trouble by devaluing the currency and passing the problem through somebody else. And this is something that I think it's coming back in a meaningful way, and that ultimately, how do you defend from it? I mean, so far, we've seen pretty much all central banks doing the same thing. So the other guy brings rates to zero, I need to defend myself, I do the same. Mm-hmm. But at some point, there's also an element of, trade wars, right? And if you devalue by 20%, I'm going to tariff you by 20%. And so you bring all these things together, the underinvestment, the big trends, the green initiatives, which are giving us the excuse to spend like crazy. And then you see the drawbacks that come into the form of higher commodity prices and bottlenecks. And it's all of a big mess where the energy, the inflation, angle, I think it's really, both the solution, because this is how the movie ends, but it's also the Achilles heel that exposes the bluff from central banks and how their monetary and fiscal policies without limits create, solve problems, which I have to insist. And this is one of the most important messages for me is you do not solve problems by printing money and taking debt. You just don't solve them. What you do is you delay the problem. You kick the can down the road in form of debt and whatever. It's a generational issue first. Second, you're going to transfer the problem, as we discussed, through currency wars and trade wars, creating these dynamics. But third, and very importantly, you're transforming the problem. You're transforming the problem into bubbles, into inflation, into inequality, and ultimately and sadly, these policies actually enlarge the problem. So we're in a situation where by now have bubbles that are too big to fail, which is the reason why central banks have been trapped with artificial valuations that on the one hand, inflation is putting pressure on them, tapering and hiking rates. But if you actually do that, you see that the emperor has no clothes. You see a lot of these artificial valuations collapsing, and that will force them to intervene and print more and stuff. So we're in this circle with a very difficult exit where the end game is inflation and sadly stagflation. And this is all related. I mean, you can pinpoint and try to blame one part of the other, but it's all very closely interlinked in a world with massive imbalances.
Yeah, I don't think you can get away from that at all. I mean, it's all interconnected when you start talking about global commodities, global trade, and that's very well put, Diego, where you go from transferring through trade wars to transforming and into people's cost of living, and sadly, that's there are a lot of different places we can go on that, but one big one and one very obvious one that I think you have views on is what's just recently happened in the property bubble that was China. But now China's got a major problem. I mean, I call this quad 3 stagflation, where you have rising inflation or cost of living, and you have real growth slowing at quite a fast rate in China at that. So what does that blow up? It blows up the debtor, and now we got a big story here. And I think there are a lot of different opinions on where that ultimately goes. I'd love to hear yours, but also just coming back to how you can't get away from it. It's all interconnected.
Yeah, I think China is a beautiful case. Well, beautiful. It's a perfect example of a lot of the things that have been happening. So
it's maybe a beautiful fractal or something that ends like in a bad.
Like
thing.
A perfect storm. It's a beautiful problem. It's like a beautiful case study. But basically, the situation in China is very dire, and it worries me a lot. I compare China a little bit to I use the analogy of Lehman squared, in the sense that, two things. First of all, if it was a movie, it would be the sequel. It would be like Lehman 2. We didn't really solve things in 2008. We transformed, transferred, whatever. And you're now in a situation where we have these problems, magnified to the point that there's not Lehman 2, it's Lehman squared. And this refers more globally to this mess that we created on a global scale, where China is a meaningful part of it. So in China, what you see is, despite all these beautiful words and plans to effectively change the economy and create, rely less on exports and become more driven by consumption, domestic and stuff. And they've done a lot of great things there. But the Chinese economy and the Chinese model is very much obsessed with control. And it does it in a way that where it imposes a lot of rigidities in the system, be it the one-child policy, the currency controls, the monetary policy mechanisms, and everything else. And when from the outside looks like an incredibly robust, solid framework, it's actually potentially quite fragile under certain circumstances. It's a bit like a concrete building in an earthquake, right? It might look very, very strong. And so with China, what you see is that the country basically has, let's start with, to keep things simple, let's start with the currency controls. So you decide that you want to control the exchange rate, the flow of money, and you make it very difficult for money to go. And then what you do is every time you face some crisis, you're going to effectively print a ton of money, which cannot really exit freely, right? So what happens with that money that is printed, and stays in the system? Well, it kind of flows into things like real estate and infrastructure. And you sort of create this dynamic where it's been about 30% of the Chinese GDP is related to construction. And so you have this dynamic where all this liquidity, all this money, all these imbalances, in my opinion, actually flow into this and create higher and higher valuations and a model that has a lot of leverage, and also creates, China has its own idiosyncrasies, right? So one of them that worries me a lot is this very complex framework of implicit guarantees, right? Where does the government end, right? You have the banks effectively pushing monetary policy as an arm of the government. And so what you end up is with this ginormous bubble, which it's a matter of time. They implode by their own weight because, you've been creating or pushing valuations to a point where people can't really afford them, right? Because that's, and so the model, the leverage, the nuisances take us to a point where, on Twitter, I was saying that I think Evergrande is more like Bear Stearns than Lehman. But what I mean is we're going to look back at this, at what's happening right now, and connect the dots and see that this is the tip of a giant iceberg of, leverage, bubbles, and implicit guarantees that is clearly too big to fail. But how does this end, and how well, clearly, in my opinion, the first phase, and we've seen today, and that's why you pick very timely dates. We've seen also today Fantasia, right? Another big developer not paying, right? The bond going to 38 cents on the dollar, massive plunge overnight, and that's why I say this is the tip of the iceberg. The model is there. It's of ginormous scale, and basically the government will have to intervene. Yes or yes or yes. I don't see how they let this thing implode. And the way they intervene is by doing more of the same, by printing more. And so I think that, this phase one, you might try to contain it. You will have some good headlines. Maybe we restructure this part. We implicitly guarantee that. But everything is actually coming through money printing. There was a tweet a while ago that said, PBOC, the Chinese central bank or whatever, injects 10 billion, or the government, whatever, it injects $10 billion dollars into the banks. And the answer was, what I replied was, no, it didn't. He injected 70 billion yuan. It's not the same, okay? You can print yuan, you cannot print dollars, right? And this is what's happening to China. So they will fix everything by printing yuan. And these ginormous problems that were originated by printing yuan are now so huge, and they're creating inflation and bubbles, that as these things implode, they become systemic, and they give no choice but to basically print more. And this is why we hold the view that it's not a new view. I mean, this is not a new problem, but we do think that the yuan is the degree of freedom of the system. You know, you've seen in terms of entry point, now the yuan is at the strongest we've seen in a long time. And I think this ties in with another big battle. You know, we talked earlier about currency wars and perhaps the battle for reserve currency and how China is positioning its currency and its economy as a pillar of stability. And it really puzzles me how well behaved the yuan has been. Actually, the euro's collapsed. Everybody left and right there are moving. They are just showing this relentless stability, which doesn't really add up, in my opinion. And part of it is, you know, over the last few months, and we've seen a massive move into people that were running away from, we're looking for yield, buying the Chinese government bond. I mean, 3% yield for 10 years. And the currency is going up. I'm earning 3%. This is free money. Guess what? The Chinese yuan this is a case study of carry trade. And if volatility explodes, I think, and some of the dynamics change, the model slows down, the energy crunch, all the things that are happening in China for me are a bit of a perfect storm. And we would be naive to think that this is just a China problem. This is a huge problem. It's a symptom, and we think the degree of freedom will be the currency, but obviously volatility could pick up substantially, and the contagion effects across obviously the sector, but EM and others are non-negligible. And this is happening with Turkey printing 20% inflation for last month. I mean, there are just so many things happening that it's. I know. You feel like the boy who cried wolf, but come on, guys. There's just so many things happening here that to the red flags to worry about that I don't think they have an easy solution.
Yeah, the Chinese yuan was up 0.3% versus the dollar last week. On a 3-month basis, it's up 0.4% against the dollar. It's just like you said, it's perplexing. But at the same time, I mean, you know, they have a closed capital account. I mean, like you said, they're printing yuan. They're not printing dollars. You know, what changes that? I mean, you can print to infinity, obviously, and you're not going to open the capital account. So how do you get the currency other than just, you know, and again, gravity is an answer. I get the answer. I mean, you could just start to show instability or rate of change vol in the currency. But, you know, for now, that seems to be, you know, their bailiwick is we got a closed capital account and this all stays inside China.
I mean, I think you have a lot more, I mean, you have a number of experts, including Kyle, coming. But look, I think let's put it this way: transparency and is not the biggest of the strengths of the numbers. I think I have enormous respect. I love the culture. I speak some Chinese. It's nothing personal here. I'm just saying that there's a lot of stuff that is very rigid, and some of these things don't add up. They do not add up. And you could, of course, you know, when you look at the current account, capital account, when you start to fix certain things in the system, something else will give. Right. And what we've given here is domestic inflation bubbles, and they're now at a point where they're just too big to fail, and 2 + 2 = 4. I mean, if they don't want the real estate market to implode, and that's about 70% of the savings of Chinese people and 30% of the GDP and the economy, etc. If they don't want this thing to completely implode, as we saw in Spain and many other places in the world, they're going to have to print and provide huge amount of money that is more yuan. So if you add to that the crunch in energy prices, this could easily turn the Chinese current account the wrong way, and that's what happened back in, you know, with oil at 120. So be careful, because there are a number of mechanisms that will just expose even more some of these dynamics. So I think the complacency that you see with the current dollar yuan or the volatility or other dynamics are in my view not warranted, and they're actually opportunities. I mean, very often, you know, as I always say, insurance is cheapest when you need it the most. Yeah. You know, it's always when the S&P is at the highest, that the VIX is at the lowest, and very often, you know, these things happen that way. So it's not easy. It's painful. If you, like us, have been you know, negative on China and the yuan for a while, it's not fun. It's not painful. But I think this is a matter of when, not if. and I think these dynamics are accelerating, and you can see again the red flags over in every dimension. So I can see a number of catalysts that could trigger. Don't get me started with geopolitics. I mean, we just overnight we saw news of what's happening in Taiwan, in India. These are pretty major issues, surrounding China with domestic bubbles, with defaults, with geopolitics, with all sorts of stuff that are happening in one of the big engines of the world for the last 2 decades, and certainly is something to be quite mindful and monitor closely.
Yeah, the thing about China, I mean, there's plenty of money to be made on the short side of China. Like I always say, if you're bearish on China, just short China. In fact, shorting Hong Kong was even better because they don't mark up the close in the Hang Seng like they do in Shanghai or Shenzhen. But you really, whether it's the ETFs like FXI or CHIQ, CHIQ is one of our shorts as a China consumer. I mean, there have been plenty of ways to make money on the short side of the Chinese. Now, the economy, like they can't change the dynamics, and I think that's part of your answer is that everything around you can command and control whatever you want. You could reduce time to 3 hours per week on video games, allegedly. You can do everything as crazy as a communist might do, but you can't change the stagflationary dynamics that you're importing, based on not just your economic realities and your response, but everybody else's. So that's, it does, like if you get into deep quad 3 stagflation, which is basically what China is developing now, we don't have that in the US. We still have 6% real GDP. In China, they're making up the GDP number to start with, and they're going to have the lowest real GDP number that they've had since entering the WTO. So this is a brave new world to be, a central planner in China and think that the rest of the world's not going to affect you.
I agree. It goes both ways. I think on your point on ways to short China, I'll just make one comment. Is obviously these are total return games. So you need to think about not only what the equity index does, but what does it do in your currency, right? So the Venezuelan stock market could go up 10,000% and you still lose money because the Bolivar went to zero, right? So in fact, a massive devaluation would be extraordinarily bullish for equities, right? Because on a total return basis. So that's just something to be mindful, and why I actually think the currency, even if it has negative carry, is interesting. And I think Taiwan happens to be a good proxy with actually positive carry. So plenty of ideas there, but I think what you guys do is awesome, but we just need to be mindful of that total return. But I think the relationship you pointed out, it's two-way. China depends on the world depends on China, and that's something that we've built ginormous expectations. I mean, obviously, we could provide a counter argument to the first 10 minutes of the discussion with commodities. What if China slows down, and how does that change? And I think that's why my point goes on to also volatility, right? It's there are really strong forces in both directions, and a slowdown in China is a non-negligible risk to look at, and based on the expectations of growth and consumption in China and beyond, this is where perhaps the frothiness of many parts of the market could also be exposed.
Well, it's always the worst place a country and a government can be, whether you're communist or not, is in the middle of a cyclical downturn with long-term secular headwinds hitting you right in the face that aren't going away. I mean, so
absolutely,
that's where China is. I mean, it harkens back to the property bubbles in Japan, and it's not like, again, I hate making the analogy like it's China today. The problem with China today is that it's China. It's not Japan. It's China. That's where they're at. If you don't mind, I'm gonna get like some of these questions are popping up. So if you don't mind, and then that'll help us jump to some of your other areas of expertise, I think. In addition to everything that we've talked about, this is the number one question from Daniel in Connecticut. What is the biggest risk right now in basically in global macro markets? Because we've talked about China and energy, obviously.
I mean, long term, the way I think about this and tying in with portfolio construction. Last time we talked about this idea that a portfolio is like a team, right? And we emphasize a lot this.
Everybody loves that.
I think we emphasize this idea that you need strikers, midfielders, defenders, goalkeepers. This is the perspective of building a portfolio with respect to risk. Okay, long risk, short risk, and here the key lever of the system is volatility, and this is where a sudden spike in the VIX around 30, which could happen today, effectively will lead to today or any minute. I mean, but today is a good candidate. That increase in volatility effectively creates an increase in value at risk, which forces people to cut risk and touches into liquidity and increases correlations. And before you know it, you have effectively an exponential increase in risk metrics, which actually feed into these mechanical collapses. But the second big dynamic, which is unavoidable, and we've spent a fair amount of time already today talking about it, is inflation. So when you build your team, it's not good enough to say, I'm just going to have strikers, midfielders, and goalkeepers. You actually need to know whether they're long or short inflation.
Right.
And here, the guys that are going to pay for this party are the guys that are short inflation, be it cash, fixed income, and credit. These are the areas that I think are the weakest links, and where you want to avoid. And this spike in inflation and this risk of inflation alongside with risk is one where, at the end of the day, what do I mean by being short inflation? What I mean is, if you have a bond that you invest $100 or euros, and in 20 or 30 years is going to pay you back 100 euros, I tell you what, those 100 euros are going to buy you nothing. Okay, nothing. And this is what inflation means. So if you want to be in Telefonica for, you'd rather be in the equity arguably than in the credit, right? Because from an inflation perspective. So I think looking at the question, I would say these two dimensions are very important. Build your risk with respect to be mindful on your portfolio, mindful on the risk side. You need things that will do in the different environments, and perhaps you need to, a lot of people have way too many strikers, way too complacent with a long market positioning. So we need to balance that out. And second, be careful, because inflation is the end game. But beyond that, other catalysts, we talked about energy being potentially, again, something that is surprising people, coming from behind and not something that anybody expected, and putting some bleak questions on the table because we'll not be able to fix it. Geopolitics is obviously another one, but ultimately, I think the bubbles, the size of the bubbles we've built globally is so large, and the setup is so artificial that we're entering a phase where, as this crisis come, whichever the origin, we're going to see mommy and daddy doing way more of the same, way more printing, way more debt, and this is going to reinforce this process that we discussed. So we're doing these iterations of the system. The complacency is worrying and excessive. The leverage is there, even if it might look be less obvious or hidden. And I think we just need to be mindful. Play for the long term. I'm not arguing, for just put everything in goalkeepers or strikers. I've always talked about have a balanced team, take advantage of the volatility, and also bear in mind that there's a new dimension here called inflation. And I'm going to put it in an example I use. I have teenager children, and if I explain, listen, if investments was a video game, we have three levels, right? Level one is, can you make money in nominal terms? So can you take your $100 and turn them into something more than $100, right? And to do that is still relatively easy, right? If you just park your money in certain parts of fixed income or whatever. Level two is, can you make money in real terms?
Right.
And this is where we're now, right? And people are starting to awake to the reality that, yeah, I know you're paying me 1.5% for 10 years, but that's already, losing me, over whatever, another 10% in real terms, in terms of purchase power, because of my inflation, and this is rising. And the third level is, can you make money in real terms after taxes? And this is the one thing that it's certainly coming in as governments try to close the circle with the bubbles and inequality they've created. They're going to have to basically do that. So it's nothing new. I mean, if you do a bit of history reading, many of these things have happened, but they've certainly taken a dimension that we've never seen before.
Yeah, and I'm sure when you ask a teenager about paying their taxes, you take them to a place they've never been before too. So nice job with that. Good risk management. I love teaching my kids like how the game is played. I mean, they're certainly not going to learn that in school. And I do think. I mean, your answer to that question, and actually the top three question is from Josh in Bristol in the UK. What would your actual goalkeepers and defenders be? I mean, I think what you said prior to answering that, and please do, most people are still, and consensus is still long deflation, whether they through duration or not, whether they admit it or not. That is the consensus net long position. Long-term treasuries. I mean, it's not gone away. It's paid off, for years and years and years. And I think that's a really important point, that you said that some of the weakest players on the field are the ones that used to be the strongest, which is very interesting, and it's new.
Yeah, I think to your point on long-term treasuries, I think one of the points I've been making for a long time is that the rules of the game have changed. And they've changed in the sense that if you look at the textbook says, look, if inflation comes, we need to hike interest rates.
Right.
And that's what the textbook says. Why? Because, right? It's the mandate, whatever. The problem is that the bubbles we've created with artificially low interest rates are so huge that if you try to hike interest rates, the bubbles implode, and that will effectively expose this huge issue, which will force the central banks to eventually bring rates lower. So it's a house of cards where valuations are artificially high, and we're in a new paradigm where you're going to have low interest rates and high inflation. Mm-hmm. And you cannot, I believe that, yeah, we might get taper, you have to, but it's going to be glacial. And if things start to happen the way they're starting to unfold and unroll, it's going to be an extraordinarily difficult position for central banks to do what they need to do with respect to inflation versus the systemic risk created by bubbles. And maybe the policymakers have sold all their equity by then, by which point they seem to be now, it's a good timing for them to be dumping this on ethical grounds. But jokes apart, I think you have this dynamic that is very tricky. So with respect to goalkeepers, the best goalkeeper ever it's going to be volatility and insurance. The problem with it is that it's extraordinarily expensive. Mm-hmm. If you bought something like the VIX, you'd be down 70% on the year. Well, maybe less now because the market's rallying, but it's not just about the nominal move in the VIX, it's how much it costs you to keep that position. And this year has been on average about 10% per month. So it's like, it's brutal. So your $100 become 90, become 81, and this drain has been brutal. So by the time the event happens and the VIX, goes through the moon, you're effectively capitalizing from 30 cents. Yeah. So you need the VIX to triple in order for you to break even, if just for this year. And this is why it's so difficult, right? You want to have that risk premia, you want to be covered, but the VIX has been extraordinarily painful and difficult. If you try to do things like puts in the S&P, good luck. I mean, the thing has been a straight line. You look stupid having bought those puts. If you do like we do, which we, as the market goes up, we reinvest and buy more insurance. It means that, we're loaded on insurance here, but it's been a very painful path. So I guess it's true in football, it's true in insurance, in markets. Being a goalkeeper is difficult, but I think you need them. And I do believe, we haven't talked about gold yet. I think gold has it's a textbook anti-bubble in my view. It's one of those assets that it's, in my opinion, artificially cheap relative to all the currency story we've discussed. It's, in my opinion, potentially going to be an effective hedge, even if it hasn't done that well on the outset of previous crises. I think because of the dynamics we discussed and central bank responses will do well. And then the third parameter is the contrarian nature, and it's been an absolute slaughter of gold miners. So I think your goalkeeper should include certainly. I mean, long-term treasuries have the potential to make money in nominal terms. They will suffer from inflation, but so do many other things. I think gold has potential to do things, the VIX, but the timing is tricky, insurance in general. So I think, the building that defense, it's relevant, but also you can just take some risk off on the offensive side. So if you don't have ways to find the good defenders, at a minimum, you should avoid leverage and you should be more cautious. And that's what you need to do first and foremost. I think in this environment, this is a time to be a little bit cautious and avoid excessive risks. But if you can actually find ways in which you can defend the portfolio and generate big returns when everything collapses, as we certainly hope to do with our mandate, then that allows you to have a more balanced book that takes advantage of this volatility. But it's an increasingly more fragile environment and certainly a very difficult job to be a goalkeeper.
Yeah, nobody said that this job was easy over time, that's for sure. But thank you. We're unfortunately out of time. I could keep asking questions for another hour, and so could everybody else. But thank you for your time and also for your framework. I mean, people now know exactly how to ask Diego the questions within his framework, and goalkeepers, defenders. I love it. So thanks for leading us off. We appreciate your time.
It's been my absolute pleasure. Thank you so much, everybody, and enjoy the rest of the conference.
All right. Thank you. Up next, we have the one and only Ben Hunt.